In today's video, I'll share an options position that consists of two different spreads in which I'm looking to play an idea inside of Burlingame for this overall setup that we see that's currently shaping up. Now, in order to get to the spread, the ideas of why bearish inside of Burlingame, the different price levels, it's important to first start with the S&P 500. So using the S&P 500, this is what I've been monitoring now for quite some time, which is this longer term downtrending channel. That's the channel that stood out to me. It's the longer term trend, which I think is still to the bearish side. We've been making lower lows all throughout, and each time we've had our move up, that's been nothing more than a bear flag. So using that same lens here, knowing that I have a bearish bias, if we zoom in, we can see that our recent shorter term uptrending channel has now been broken. We've also seen our edge signal confirmation, which tells us that, hey, price action has not only hit the upper trend line, but we're now also overbought using the edge signals indicator. We've also seen the 3 EMA cross below the 8 EMA on the SPY. So all signs here pointing to shorter term bearish activity now inside of the SPY, basically breaking outside of this uptrending channel. Now the SPY here, I think, is likely to continue chopping around a bit more and maybe even retest that 400 price mark one more time, maybe even testing the underside of this channel. So I think there's a little bit more chop that might come in the SPY. However, using this bearish perspective, I went looking for new setups, and there I used this scan right here. I can show you what it looks like. It's our extended Keltner channels indicator, and I'm really looking for places in which we have the upper wedges forming, so we're breaching outside of the 3.0 Keltner channel upper bands. That's been happening at least 5 times over the past 10 bars, so this shows me some level of consistency. And I also added in one more overbought indication here with the down signal using the RSI. So running that scan here, if I click OK and we run it, we get 4 different stocks that meet our criteria that also have weekly options. Inside of these 4, the one that stood out to me the most was Burlingame. So let's go ahead and take a look at that chart next. Inside of Burlingame here, if we use our longer term trend, this is the trend line that stood out to me. We've been making lower lows all throughout, and most recently, with earnings as our catalyst, we've now broken outside of this longer term downtrending channel. Now, if we show the same chart inside of TradingView here, we can take a look using their regression lines tool, the regression lines price channel, which I found to be a little bit more interesting or useful, I should say, compared to Thinkorswim's. We use our starting point, we use our end point, we get a very similar channel inside of Burlingame that has very clearly been broken. We also see the edge signals indicator in TradingView, which tells us across the board here, Burlingame, nice setup in which we've broken outside of the channel to the upside. However, it wouldn't be, let's say, unlikely to see a little bit of a fill back down towards the bottom end of that channel, the top line of this. Inside of Burlingame, that would really give you a price point, let's call it near 170, which would be this gap fill, down to about 160 to the bearish side. So that's what we're seeing in Burlingame. However, on the bullish scale here, if we try and paint reasons why this bearish scenario might not work out, we have all of these Keltner channel wedges, which told us that, hey, price is outside of the 3.0 Keltner channel. And once they stopped plotting, we went and we still formed a new high. So this right here to me would be a red flag. The fact that we went over these previous highs here, even though it got rejected, the fact we were able to do that is to me a sign that, hey, there might be a little bit more strength left inside of Burlingame. So that's one red flag to be cautious of. Another could be that, hey, we're really just inside of this trend line here, and this trend line just might be widening a tad, and we might see a strong bullish candle here tomorrow, and that would change the premise of this overall setup. So I think there's a few different things that would change this idea, and I'd like to be positioned in a way that I can withstand a shorter move to the upside, maybe even, say, chopping around this 200 price point. But my overall longer term target that I'd like to really craft this position around is this gap fill near that 170 price point. So I'd like this position, whatever options position we craft, to profit if we make a slight move up or if we make this move down towards that 170 area, which I think is likely. Now, in both cases, I think our stop for this idea would be really above this candle right here. So if we form another high above 207.34, that to me would be a point that, hey, we need to do some trade management here. We need to either get out of some spreads or maybe fix certain legs in order to try and now work for what the charts are telling us at this current moment. However, using this as our status scenario, this is the position that I'm currently looking at. It consists of two different calendar spreads. The first is a call side calendar spread targeting that 170 price point. The reason I like the call side spread here, if we use the put, it was a little bit more expensive. The put side also gave us negative theta. If I turn off the second calendar here, our theta using the put side spread was negative. And let me cue this back up to December 11th, today's date. So this is what the position currently looks like. The call side looks significantly better on the Greeks to me, and it's cheaper. So I chose the call side for that reason. Same overall idea though, we're looking to get down to that 170 price point and pin near 170. So that's the premise of this first calendar. The second calendar is, let's call it a slight insurance policy, where we're using the 200 strike in case we tend to go up from where we're currently at, but maybe we don't go shooting up, but we're just chopping around here. So maybe something like this, maybe we go up, come back down, 200 is the line we hold for the next, this is January expiration, so the next 40 days. So coming back into our risk profile, the two calendars together now, if we take a look at them, give us a P&L graph that looks something like this. What we see here is currently this position, if price stays where it's at, or here, let's change this to 200 actually, and change the bottom one to 170 and run the scenario. Let's see what happens. So currently, if we were to hit any of these, this position would be negative. However, as we start to add more time passes, and this is of course using these two as locked prices, see how this position changes. Now, we're starting to, on the 15th, so that's throughout the course of this week, the latter end of this week, we start to see this position take a positive form based on wherever we're forming. We're just collecting the actual time spread there. The theta is working for us, not against us. As we get closer and closer to January, and our expiry is January 20th, we can see what the P&L graph turns to. 170, we make money. If we stayed near that 200 price point, we make money. If the stock just chops around where we're currently at, we make money. The scenario in which we lose money is if the stock starts to go up much above where we're currently destined to stop at, which is 214. If we exceed 214, then this position starts to go negative. Max loss on the upside, negative 103. Max loss on the downside, negative 130. Manageable risk. However, if we do pin perfectly at, say, either one of the two calendar spreads that we have, so either 170 or 200, we have a greater profit than the amount risked on both sides. So that's the reason I like this spread. The other reason I like this idea also is we're long volatility. And if we take a look at the IV percentile here, 15% to me suggests that the likelihood of volatility increasing is much greater, especially if we start to see a bit of a sell-off here. So that's a long-winded approach for me to tell you why I like the two calendar spreads inside of Burlingame. It all starts with a bearish bias in the S&P, which I then went looking for bearish setups. Burlingame looks interesting in a scenario in which we're protected to the slight upside, to the downside, all the way down to 170. If we exceed even that, then of course, yes, this position goes negative as well. But we have a good deal of time to react up until that moment actually happens. I hope you found this video useful. Take care, everyone, and have a great week ahead.